Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hello, welcome to the College Investor Audio Show. Today we ask and answer the question, what are Section 7702 retirement plans? Well, let's get right to it. So in the United States, there is a slew of tax-advantaged retirement accounts. Maybe you've noticed. They form a veritable alphabet soup, if you will, of acronyms. Each account has its own rules, advantages, and disadvantages. The retirement landscape is large and laden with jargon. The confusing gives room for unscrupulous salespeople to pitch fake retirement accounts to unsuspecting consumers. The Section 7702 retirement plan is one such fake plan. Section 7702 of the Internal Revenue Service governs the taxation of life insurance policies. Some of the tax advantages within Section 7702 mimic the advantages of qualified retirement plans. But these life insurance plans aren't alternatives to employer-sponsored retirement plans or other qualified plans. They are a different product altogether. So here's what you need to know about these life insurance policies. The first thing you need to know is Section 7702 retirement plans aren't retirement accounts. Section 7702 plans are tax-advantaged cash value life insurance policies. They're sometimes called Section 7702 retirement plans, but these are not qualified retirement plans. The nomenclature is a misleading marketing moniker designed to mislead people into viewing the life insurance policy as a viable alternative to legitimate tax-advantaged retirement accounts. To be clear, the 7702 retirement plan is not a tax-advantaged or qualified retirement account. It's a life insurance policy, and typically an expensive one. What are cash value life insurance policies? So a cash value life insurance policy, they're just basically life insurance policies with a savings component. The savings build up into cash value. The value tends to increase over time because the cash value held inside the policy earns interest and grows due to investment growth. Growth in the policy account is tax deferred. That means it is not taxed until the funds are withdrawn from the policy account. All of these policies require policyholders to pay monthly premiums to keep the life insurance in place and build up the cash value of the policy. All the policies pay a death benefit when the policy owner dies. Over the many years, the savings component of the life insurance builds up and becomes invested. However, the exact investment and returns vary based on the type of insurance policy. Whole life. Typically, whole life policies have a guaranteed minimum growth rate for the cash value in the policy, but they may grow somewhat faster depending on the performance of the fund. Once the cash value is adequately built up, the cash value can be used to pay the monthly premiums. Variable universal life. Under a variable universal life policy, the cash value in a policy may increase or decrease depending on how the policy is invested. Policyholders may have control over how the funds are invested, but the potential volatility may cause problems for people who intended to take loans from the policy to fund living expenses. Indexed universal life is another one. The cash value in these policies is tied to a specific stock market index. In these policies, the rate of return on cash value will not dip below 0%, but the upside is limited compared with variable universal life. Understanding Section 7702 life insurance policies. Section 7702 of the Internal Revenue Code lays out the rules for tax or cash value life insurance policies. Cash value life insurance policies, also called whole life or maybe guaranteed life policies, are first and foremost life insurance policies. If the policyholder dies, their beneficiary receives a large payout from the insurance company. Almost all cash value life insurance policies are Section 7702 compliant policies. By complying with the rules in Section 7702, the cash value inside the life insurance policy can grow tax-free. Additionally, Account holders can borrow against the built-up cash value inside the policy, either to pay the premiums or to fund living expenses. The tax-free loan may be used to hoodwink unsuspecting consumers into seeing a cash value life insurance policy as a viable alternative to a retirement account. Are Section 7702 life insurance policies bad? With all that said, cash value life insurance policies aren't bad products inherently, but they aren't a great fit for a typical person. Typically, the upfront fees and commissions are very high. Due to the front-loaded fees, the cash value grows slowly for several years. A typical person may pay thousands of dollars into the plan and get little in return. The slow growth may explain why 20% of people allowed their whole life insurance policy to lapse in the first 3 years in the most recent study by the Society of Actuaries. These folks probably saw returns that were pennies on the dollar compared to their premium payments. Even for some people who keep their plans in place, the investments tend to be run-of-the-mill mutual funds. They don't have a secret sauce for outperformance. While cash value life insurance policies do have tax advantages, most people don't have adequate income to cover all their expenses and max out their real retirement accounts. In 2021, a working person with an above-average $80,000 per year salary and a high-deductible health insurance plan for their family is eligible for all the following deductions: a $19,500 employee contribution to a 401k, a $6,000 contribution to a Roth IRA, and a $7,200 contribution to an HSA. That's $32,700 in tax-advantaged investment opportunities. When you consider other financial priorities like paying off debt, buying a house, saving for kids' college, the whole life insurance policy is unlikely to fit. If you're already knocking your financial goals out of the park and you still have strong cash flow, a cash value life insurance policy may fit for you. It can be useful, part of your estate planning, especially for people who are relatively young and relatively wealthy. However, even those who fit the bills should consult with a fiduciary financial advisor before buying any cash value life insurance policies. A fiduciary must work in your best financial interest and should make a solid insurance recommendation for you. Should you cancel your 7702 life insurance policy if you have one? Cash value life insurance policies are typically not the best purchase initially, but the fees tend to be front-loaded. As a result, an older life insurance policy may be valuable if you can afford to pay the premiums. We have a link from a CFP that explains scenarios where keeping the policy in place does make sense, but you might want to work directly with a CFP to help you analyze whether to keep your policy or not. Overall, Section 7702 life insurance policies are legitimate financial products. They have a place in certain financial plans, but profiteers may try to sell you a high-cost policy even if you aren't the right fit. Ultimately, it's up to you to learn about these plans and to seek the advice of qualified advisors before you buy a plan you don't need or want or can afford. Thanks so much for stopping by today. I hope it was helpful if you've heard about these 7702 retirement plans, quote-unquote retirement plans. If you want to find out more about it, see if it could be the right fit for you, you can find this article. Just copy and paste the title of this podcast into the search bar at thecollegeinvestor.com. Thanks again. We'll talk to you again real soon.